I'm Alison Hinson, and today we're going to be talking about how to get a loan to buy a house. For many people, buying a house is something they want to do, and we're going to talk about how to get that special loan called a mortgage so you can buy a house of your own. And our guest today is Kaleigh Deering. You are a mortgage loan officer with Bangor Savings Bank here in Scarborough, Maine. So welcome to the show.
Thank you, Alison.
So was my definition of a mortgage correct? It's just a fancy name for the loan that you get to buy a house.
Yep, basically it's just the legal agreement between the bank and the borrower that they agree to lend money at an interest rate, and they in turn take a lien on the property.
So that
really
means the bank really owns the house.
Until you either pay the loan off, or if there was a situation where you couldn't pay the loan off, then the bank would take the house. So that's how that works.
So it's a loan, and I know that I have to pay it back, or else the bank becomes the owner instead of me.
Exactly.
And I'm assuming that that happens very rarely. Most people go in and get a mortgage, and they live in the house, they make their payments, and they are homeowners.
Exactly, yes. It's very rare that something like that would happen. It's usually you have found the house, you agree to the certain terms and conditions, you sign, and then the house is yours.
That brings us to the first question I have is, how do you know if you're ready for home ownership? How do you know if you really can handle this? Because it's probably the biggest amount of money that anybody will ever borrow, is because the loan means you're going to the bank and you're asking them to let you borrow money. How do you know if you're ready for home ownership?
So technically, anybody that is of the age that they can enter into a legal contract can apply for home ownership.
So anybody 18 or over could walk in and say, I want to buy a house.
Yes. But that doesn't necessarily mean that maybe they're ready to buy a house. So typically, when people are starting to think about it, especially you're hearing now rents are really high, and there's a lot of conversations about how, your mortgage could be less than what you're paying in rent, or it's a good investment. But it really comes down to the person themselves being ready. Usually I tell people you want to have some type of savings to make sure that you are ready for home ownership, things to come, repairs, improvements, things like that, unexpected expenses that go along with owning a house. You also want to have a stable income that is coming in so that you feel comfortable that you know that you can make your payments every month. And you also then really want to understand what the budget is that you have that you can set aside for a mortgage. And lastly, you want to have an idea about your credit and if your credit is at a place where you can qualify for a mortgage.
So there's a difference between wanting to buy a house then and being financially prepared.
Exactly.
Even mentally prepared.
Yeah.
Before we bought a house, my husband and I would go to Home Depot, on Friday nights and walk around and think, oh wow, if we had a house, we could do this and this. And then I remember we bought our house and we went into it and we went to throw out some garbage and we thought, we don't even own a garbage can. So, the first thing we had to do was go to Home Depot and then buy a garbage can. And that's what I think you need savings for. You walk into your house and you think, there's nothing there. It's all you. You have to then come up with the money to go buy the garbage can or buy the shower curtain or buy the, the rod to hang your towels on. It's all on you. And that's what you need.
Something to sit on, something to sleep on if you don't already have certain things. Yeah, it's probably the biggest commitment that you will take financially. So yes, it's important to be prepared.
How do I then go get a mortgage? Say I think I'm prepared. So I think in my mind I've got the money set aside. So you talked about credit. Maybe I've looked and realized that, yeah, my credit score is good, and I've looked at my budget and think, I think I'm ready. I've done all the things you mentioned. I think I'm ready. Now what do I do?
Yep, so there are lots of places that you can go and get a mortgage. Usually it's through a financial institution.
Like a bank, credit union?
Bank, credit union, mortgage broker. You can do them through somebody that's local, or you can do it through somebody that's national.
You mean a bank or?
Both. You can use like a company that is a national bank or a national mortgage broker.
What's a mortgage broker?
So a mortgage broker tends to be somebody that is not a financial institution that offers both loans as well as deposits. So they're really more of a specialized shop that just focuses on mortgages.
So a bank will give me my checking account and my savings account, maybe do a card, but a mortgage broker is just going to offer me that loan to get a house.
Exactly. And then there's also situations where the mortgage may, once you actually close on that mortgage, it may stay with those financial institutions. Typically, when it is through a mortgage broker, it doesn't stay there. It ends up going to another financial institution.
But that doesn't matter to me, really.
No, it doesn't matter. It doesn't change the terms or the conditions of the loan that you agreed to. It just changes who you're making the payment to.
So let's say it's so easy to get on realtor.com or get on the internet and start cruising. Cruising the homes for sale. Let's say I think I'm ready and I go out there and I find this cute little house that I would love to have. Do I just go into the bank and say, here, oh, look, I want to buy this one?
Sure. Well, it can be intimidating and overwhelming when you're not sure where to start. Mm-hmm. So typically, what I would tell you is do what you're comfortable with. If you're comfortable speaking with somebody in person, start with your own financial institution. Usually people have a checking account mm-hmm. or a savings account somewhere, and you're comfortable with the people that maybe are at that branch, and go in and talk to the people in the branch and say, geez, I'd like to talk to somebody about a mortgage. And they're wonderful and they'll help set you up with mm-hmm. who you need to be with. If you're more comfortable talking with somebody on the phone, then I would do the same thing. I would start with someone that you know that you're comfortable with at maybe your own financial institution and call and explain what you're looking for. The people on the phone are designed to maybe ask a few questions and they'll point you to the right person.
So they're not asking me the questions to discourage me. They're just asking the questions to find out who should you talk to next.
Exactly. They're going to ask you questions like, what's the most convenient location for you? Would you prefer to talk to somebody on the phone or would you prefer to go in and see someone? They're trying to narrow it down to make it most convenient and most comfortable for you. And then lastly, you can also apply for mortgages online. So you could send an inquiry through an online system mm-hmm. of a financial institution if you prefer to do it that way. So pretty much any way nowadays you can apply. But what you want to do is you want to talk to somebody that really, if you're in the very beginning stages mm-hmm. and you're not sure, I don't know how much I can qualify for, I don't really know what my credit score is, sit down with somebody and just let them know I'm in early stages and I want to get what's called pre-qualified.
So people are actually willing to do that? I can walk in and say, here's the pretty house I want to buy.
Yeah.
And they will start then by asking the beginning questions. You said pre-qualified. Does that mean like the bank or credit union has kind of blessed you and said, here's how much you can borrow?
Yeah, so typically when you find that beautiful, pretty house
uh-huh.
that you're really excited about and you see that, this house is listed by a certain realtor and you want to jump right on and call that realtor,
yeah.
Oftentimes the realtor will ask you, have you been pre-qualified yet?
And that just means the bank has said you're allowed to borrow up to so much money.
Exactly. And so everybody's terms are slightly different. Sometimes it's called a pre-qualification, sometimes it's a pre-approval, but essentially what it is that they have vetted the information and said, okay, based on the information you've provided to me, you can afford a house up to X dollar amount.
What kind of things are you going to ask? So let's say I come in, I say, oh, I want to buy this cute little house, and they start me on the process because I don't know how to do this. I've just walked in. First time for me. What are some of the things that they're going to ask me?
Sure. We ask a lot of questions.
So I shouldn't be intimidated by that. That's just your job is to ask a lot of questions. It's not like you're asking questions because you're thinking, okay, strike one, strike two, strike three, you can't do this.
Right. No, actually the information is so that we can pair you with what makes the most sense for you. And the more information that I know, the better of a program and a better fit you're going to have. But I like to joke with customers when they come in, like, I'm going to ask you a lot of questions. Your doctor and your mortgage lender probably know more about you than anybody else. And it's just because we're trying to make sure that we have all of that information. We're not sharing the information, but we need it to properly qualify you.
So by qualifying how much can I borrow?
Yeah. So we're going to ask you questions we'll ask you personal information questions, your name, your date of birth, your social security number, things like that. We'll also ask you about where you live, where you've lived.
Why does that matter? I mean, because I want to buy this cute little house.
Yeah. But what we're trying to understand is, do you have a history of paying rent? Can we show that you've paid rent on time? Or are you living at home with mom and dad? That's okay too. We're just trying to understand your overall picture. And if there is a history there of rent, if you haven't owned a mortgage before, we can use that to say, okay, this person is responsible. They've made their rent on time for the last 2 years. So it's an indicator that you're going to make your mortgage payments on time. So we'll ask things like that. We'll also ask you about employment and your employment history, and we'll ask you about your income. And the reason we're asking about your income is so we can see, based on your income, how much you can qualify for a mortgage.
Because as a mortgage loan officer or anybody that I go to for a mortgage, they basically want to know, can I repay that money?
That's exactly it.
That's the bottom line. You're going to give me some money. Can I repay it?
Yep.
If you think I can repay a lot of money, you'll let me borrow a lot of money.
Right.
If you think I can maybe not pay back that much money, you'll lend me less money.
Exactly. Yep.
So you're basically asking all these questions to find out, are you going to get your money back?
Yes. Yep. It's really, that is our security in the whole thing. We're not in the real estate business. We are in the loan business.
You don't want to own my house.
We don't want to own your house. We want you to own your house. So we're just making sure that you can qualify by paying us back.
So you said things that I can easily rattle off. You know, my name, social security number, where I've lived. Am I going to have to bring you like paper documents?
At some point you will. You can walk in the door and say, I'd really like to talk to somebody about a mortgage. And you can get pre-qualified. And again, depending on the financial institution, their program might be a little different. But you can get qualified based on just the stated information. This is what I'm telling you I make. This is where I've lived. This is how much I pay in rent. This is how much I have in the bank. And we can take all that information, compile it. We will run your credit, and we will give you a pre-qualification letter.
And that will say, oh, guess what? Here's how much you can spend.
It will say, yep, congratulations, you've been pre-qualified for this amount. Now go find your house.
Now, what if that amount is not how much my pretty little house costs? What if it's less than what my pretty little house that I want to buy costs?
So there are a couple of things. That is, sometimes it means that maybe that house just isn't the right house for right now. Or sometimes it means that maybe you're fortunate that you're a really good saver and you've saved a down payment, so we can combine the loan and the down payment, and you would be able to afford the house at that price. Or sometimes if you're in a situation where you might have mom or dad or somebody else that has the ability to gift you some funds, you might be able to afford it at that point.
So a down payment is simply the amount of money that I have saved to put towards that house.
Yep.
So when I go into the bank, I should be able to, in a perfect world, be able to say, oh, look, I want to buy, let's pretend it's a $200,000 house. I've saved maybe $20,000 of my own money. So for that $200,000 house, I'll give you $20,000, and you'll lend me the rest.
Right.
Do I have to have a down payment?
You don't have to. There are tons of programs out there.
So by programs, you mean different ways to borrow the money?
Yeah, there's different loans in the way that they can structure the loan so that you're able to qualify for the house that you want. A lot of first-time home buyer programs, there are programs geared specifically towards first-time home buyers, and there are programs that are geared towards people that have no down payments. Maine is a pretty rural state, and so most of the state qualifies for rural development loans, and those have basically little or no down payment. So there are ways that you can do a loan with no down payment, but there are also ways where you might be fortunate, again, that you've saved a lot of money and you can put a down payment down. And all that really does is it changes the monthly payments, and it might change the interest rates. It's just going to structurally change the program that you qualify for.
So as part of a mortgage, I always think of it as three parts. There's how much I'm going to be able to borrow,
Yep.
which is what you're going to tell me in the letter that says, yay, you've been pre-approved or pre-qualified. There's how long I'm going to borrow the money for.
Yep.
And then there's the interest rate, which is basically the fee that the bank's going to charge me. I mean, interest rates are basically how you guys make your money. It's
Right.
fees.
Yep.
So the amount I'm going to get through that pre-approval letter, and then I'm going to have to decide how many years I want to pay you back for that.
Correct.
For that house. Most of the time, isn't it 30 years that when you sign that piece of paper and say, "Ooh, I bought my house," I'm basically signing up to pay you back 30 years worth of payments.
Right. That's probably the most standard term. There are shorter ones, but 30 years is the longest term, and it's probably the most standard that people elect. And that is the agreed upon term. So every month, you're going to make us a payment, and it's going to have interest that's accrued, and you are going to make those monthly payments over 30 years. You can pay it off early if you wanted to, but that is the term of the loan. And then the interest rate, that gets dictated by a couple of things. Again, back to what type of loan program we put you into may or have a different interest rate. Some institutions have slightly different interest rates for different programs, and then also what the markets are doing, because interest rates run off of the market.
So when I'm looking for a loan, let's say I'll just do a 30 years, which it sounds intimidating to people, like, okay, you're signing up for 30 years worth of debt.
Right.
But that's the norm.
It is.
So the only question I'm going to have then for a bank is, how much are you willing to lend me and what the interest rate is? And will each place like maybe I can borrow $200,000 from one place, will another place let me borrow $300,000? Or is that going to be, I mean, that's what I'm wondering, should I shop around and figure out who's going to let me borrow the most money?
So I don't think you'll find that there will be swings to that degree between institutions and types of lenders. What I think you will find is, I always tell people, shop around, because what really at the end of the day matters is the fit. Again, that lender is going to ask you a lot of questions, and they're basically going to work with you. Some people, they know right away, this is the house I want to buy. They go under contract, and 45 days later, they've closed on their loan and the transaction's done. Other people aren't ready right away, and we work with them for over a year before they buy a house. So you want to make sure that you're comfortable with that person and having conversations about your finances, employment history, things like that. So I tell people, meet a couple people, see what they have for programs, see what they can offer. Interest rates probably are not going to have wild swings. They might be 0.1% different between institutions, and some programs are going to be set standard interest rates. It doesn't matter which institution you go to. It's really, to me, it's really about that fit and who you're comfortable with.
So go to different places.
Yeah, I'd say go to a couple. You want to do it within a relatively close period of time, because if each institution pre-qualifies you and you pull your credit, then you don't want to pull your credit too many times over a long period of time, because that could hurt your credit score. But I would say, shop a couple of places, and usually you're not going to lock your interest rate or lock your program in at that early stage where you're just shopping around. When you lock your interest rate in, when you actually move forward with the next steps in the mortgage process, that is when you want to kind of decide, okay, this is the lender I want to work with, and it's when you're under contract on a specific property.
How much does this cost then to, when I go to talk to these different people, I mean, you mentioned working with people for a year. Is that going to cost me anything?
No. Nope, it's just your time. And again, I think it's about the right fit for the person that you're working with. A lot of first-time home buyers, like you said, they may or may not know if they're ready. Some of them
Yeah.
are ready, but some aren't. Some haven't had their credit pulled, and they find that when they get their credit pulled, maybe they don't have bad credit, but they don't have any credit. And so that's another situation where we need to help somebody establish some credit or establish alternative credit. So it's not always just a quick, I want to buy this house and I'm going to walk in and I'm going to walk out the next day with the house.
What are some barriers that you see people run into with getting a mortgage? You said maybe they don't have good credit or they have no credit.
Yep. Credit is an interesting thing because it really is something that you want to establish credit as early as you can, but you need to manage it responsibly. So having poor credit, depending on what's on the credit report, can dictate what your score would be.
So like when I bought my first house, I was awful with credit. Probably the only reason they gave me the house was because I had a big down payment.
Sure.
And that probably mitigated the, oh wow, she clearly can't handle her money, but you know, we'll give her the mortgage.
Right, that was kind of your security
Yes.
in it for the bank, and they felt comfortable with that. But yeah, making payments on time, not letting things go to collections, all of those things are going to help you establish responsible credit and establish a good credit score. And then also having credit cards not at their maximums all the time, actually having available credit, using your credit. That's another thing. Sometimes people forget, you know, they maybe they're in transition that they've sold a home and it's going to be a while before they buy another one and they pay cash for everything.
Yep.
That's a situation where they are doing financially well, but we don't have any way to show it because we have no history of payment on the credit report. And that's really what the credit report is there for.
When I then go to get my, let's say I've overcome all these barriers, I come to get my mortgage. There's different kinds of mortgages. You've talked about the fit. There's the 30 years with the plain old interest rate. And I know that means if I get a 30-year loan at, let's pretend, a 5% interest rate, that means my payment's going to be the same for all 30 years.
Yes.
But I keep hearing about variable interest rates.
Sure.
And my understanding is that's where maybe I get, instead of a 5% interest rate, I get a 3% interest rate, which, hey, that sounds better than 5%. I'm paying less, but it can creep up over time.
Yep. So what you're talking about are adjustable rate mortgages, and oftentimes people refer to them as an ARM. That's the
the adjustable rate mortgage. Okay,
yes.
I get the ARM now.
Yep. And so what that does is that usually is done on a term of 30 years, like those fixed interest rate mortgages would be. But what's different about it is that the adjustable rate has a period of being fixed, so it's not fixed for the life of the loan. It might be fixed for the first 5 years, and that's usually at a lower interest rate than what the market interest rate for a fixed loan would be at.
So that would be like, if I got the fixed rate, it might be the 5%,
Right.
but the adjustable rate, the ARM thing, would be at 3%.
Maybe it's at 3%, and it's fixed for those first 5 years. And then after that, it has the ability to adjust, and every program can be different. Most of the time it has the ability to adjust once a year, so it's not going to adjust on you every month. It's not going to have big wild swings with interest rate, but they're usually incremental. And then it will also have a cap on it. So it says that maybe you start out with a 3% interest rate for 5 years, and then every year it can adjust once a year. It will have a certain amount that it can adjust up to that year. Maybe it can only go 2% above what your standard was every year. But then it'll also have a cap, and maybe that cap is it can't exceed 5% of that beginning interest rate. So you'll have a cap on that. Over the years, we've heard really kind of horror stories
Yeah.
with adjustable rate mortgages. I don't think people use them as often, but there is definitely, like we talked about fit earlier, there can be a reason for somebody may want to use an adjustable rate mortgage. If they know this is going to be, maybe this is my starter home and I know that in 2 years I am not going to live here anymore, I'm going to sell. That might be a situation where you say, okay, well, let's at least give you 5 years at that fixed rate, so you have a buffer, because sometimes plans don't always, we don't always follow through. So those are situations that maybe that would make sense for you. I, again, think that most first-time buyers and kind of most buyers in general kind of gravitate towards the security of just having a fixed rate for the whole life
So
of the
you know
loan.
it's never going to. Do you ever feel like a therapist when you're a mortgage loan officer? Do
Yeah.
you feel, because I feel like you go in, you tell somebody, here's my plans, here's my money, here's my income, here's where I've worked.
And sometimes it's like, oh, I have really great news. I can qualify you for that beautiful little house that you're looking for. Or good news, I can qualify you for even more than you thought you qualified for. Those are the good conversations. The other conversations are, maybe you're just not ready yet. This is the amount we can qualify you for. It could be an amount that is less than what you were hoping for. It might be an amount that still, you could find a house in that price range.
It's just not going to be my cute little house.
Your cute little house. Or it could be, no, I have my heart set on that house and I'm going to wait and I'm going to save, and maybe the job I'm in, I know in a couple of years there will be, some income potential to raise my salary. Then I'm going to wait and I'm going to buy that house. So again, it's very specific. I've been doing mortgages for about 15 years. I've never seen two transactions exactly the same. It's not, two people aren't exactly the same. So everybody's a little different, and every time is a little different.
So thank you for telling us about that, because I do think everybody is different. So if you're watching this, I hope that you can take these words of advice, and if you're thinking about buying a house or starting to save for a house, that this will give you the advice you need so you too can become a homeowner. So thank you for watching Money Matters, and have a great week.